Okay, thank you very much. I'll try to be as brief as possible. As I'm not really an expert of Asia, I will try to give you my view of what's has been going on in Europe in the recent years, and maybe try to focus a bit on what's going on in the Eurozone right now, and what are the prospects for our country, for Italy as well. So that's basically the agenda I would like to touch upon. We all know about what took place in the financial crisis in the US. Just a few words of what were the underlying main factors, because I think it's important to understand where we stand right now. What were the underlying factors? Very expansionary monetary policies, low inflation expectations, and sound economic growth. All these factors led to low borrowing rates, so cost of borrowing very low for companies and individuals, low default rates, low credit spreads, and ample liquidities. Here you can see in these charts, the one on the left above is the rate on corporate bonds. I took the BBB ones, and you can see that there is a minimum very close to the start of the crisis. The chart below is default rates on corporate bonds in the US, and these are taken from S&P, and you can see from Standard & Poor's, and you can see that in 2007, just before the crisis exploded, default rates were extremely low, so almost negligible the credit risk. The one right above is GDP growth in some major areas, EU, India, China, OECD, and there too you can see a peak in 2007. And finally, the one below on the right is the spread between BBB and AAA borrowers. So it's basically an indication of the average cost of credit risk in the markets. And there too you can see that they were at an extremely low level just before the crisis in 2007. So all this led to what? Well, if cost of debt is so low, of course, and default risk is almost negligible, there is a strong incentive to borrow. And that is why we had a significant increase in financial leverage, which led to the famous problem of subprime mortgages. Not so careful evaluation of credit risk, that was another. I mean, if you never suffer losses, of course, the incentive to monitor and properly evaluate credit risk is very low. And also we had, because of that, significant increases in real estate prices, leverage and acquisitions. I think we shouldn't forget however, one important point, which is the macroeconomic imbalance. And I think that's very important to keep in mind, i.e. the twin deficit, the fact that the US have been borrowing very significantly the private sector, and the financial balance, that a concept that we teach every day in Bocconi, was significantly negative in the US, together with the current account deficit. In some way, that was the American dream. So what did that lead to? Suddenly, when there was an increase in commodity prices, inflationary pressures started to increase, which in turn led to significant increases in interest rates, and this, in a situation of very high financial leverage, of course, led to the burst of the housing bubble, negative equity for borrowers, incentive to default, so-called strategic default, and liquidity crisis. This is basically the financial crisis. In terms of what actually took place, if we look at the US, it was the worst crisis, it has been the worst crisis in the last 50 years. Employment rate went down by 6%, GDP loss of over 5%, and all the events that you know about. What about Europe? Now in Europe, and I'm using the covered pages of The Economist, which I think are quite effective in depicting what's been going on. We start in late 2009 with Greece, confident crisis, government bond spreads start to shoot up, downgrading in 2010. The reaction is very slow if you look at that, and even slower is the reaction intervention by the Troika. They actually came up with funding only in the mid of 2010, so with a significant delay with respect to the emergence of the crisis. This is Greece, late 2009, intervention in 2010. Then in 2010, it also involved Portugal and Ireland, This is another very effective cover page of The Economist, I think, where you have Angela Merkel coming down to save Europe. And here we have the extension to Portugal and Ireland, so contagion risk becomes very effective and it starts affecting spreads of other government bonds in the Eurozone. And finally, of course, it goes to Italy, which becomes much more serious because in the case of our country, it is very, very difficult to bail out because of the size of the public debt. In the second part of 2011, that is when our president, Mario Monti, gets called by Napolitano to lead the government. And here is where the most significant risk of break-up of the euro are really felt by the markets. The ECB, of course, you know, played a very significant role. It stepped in December 2011 and early 2012 with LTRO for a total of more than 1 trillion euro. These were the very significant liquidity injections to all European banks that in some way allowed the credit circuit to work and continue to work, because clearly banking institutions in Europe were short of liquidity in a very significant way. And on top of LTRO, we also had the intervention that Mario Draghi called "we will do whatever it takes" to save the euro with OTM, outright monetary transactions, to basically purchase in the secondary market government bonds that were affected by speculative sales. So what are the major problems in the Eurozone? The way I see it is, first of all, is competitiveness, and it's a competitiveness problem with respect to the outside world, but it's also a competitiveness problem inside the Eurozone, meaning that clearly when you have one currency only, fixed exchange rate, but free capital movement and free trade of goods and services, and the competitiveness of each individual country in the single currency area is not moving in the same way, and I'm talking about unit labor cost, of course you also have a very significant divergence of competitiveness within the area. And this is a major problem, of course, for countries like ours, like Italy. How do you address a competitiveness problem? Real investments. You invest in order to increase productivity. And unfortunately, in these years, we actually observed exactly the opposite. A collapse in real investments in the entire Eurozone of about almost 500 billion euros, which, to give you an idea, is 10 times the drop in consumptions that took place in the same 6 years period, okay, and 5 times the drop in GDP. Okay, so that's the other major problem. We need to stimulate investments, real investments. Despite the huge liquidity injections by the ECB, we had a significant credit crunch, because once again, how do you address the increase in investment? Well, you borrow. We need to have, credit available to the economy for investments. But once again, we had the opposite, a credit crunch and a deterioration of sovereign credit quality, which basically created a vicious circle with a link between the banking industry and the sovereign. So in some way, the sovereign credit quality going down because banks hold significant assets in credit, in government bonds, their credit quality goes down too. They cannot lend, and so on. And the cost of loans for corporates went up significantly. This is a chart that shows the divergence in competitiveness that I was mentioning. That is unit labor cost. The line below is Germany, that has been much more virtuous, and all the others are the other main European countries. And you can see that there is a clear divergence problem. More recently, in 2012, sorry, I didn't update that, some countries like Greece, Portugal, and Spain managed to decrease unit labor cost and become more competitive. This did not occur actually in Italy. And as I said, there has been a strict link between the banking industry on one side and the sovereign debt crisis on the other side, with feedbacks affecting one to each other. To give you an idea, if you look at the evolution of credit default swap spreads, which is a very clear measure of the credit quality, you can see that the evolution of the CDS starting from the crisis. The red one is the average 5-year CDS spread for the banking industry in Europe. The blue one is the average of the European sovereign. And you can see that they are very, very closely related. So that is the negative cycle link that I was mentioning. On top of that, the banking industry in Europe, just as in other countries, but especially in Europe, has been facing a significant tightening of the regulatory constraints. This is just a simple chart that shows you how the requirement in terms of core Tier 1 capital, which is basically common equity in the banking industry, okay? The requirement by the Basel authorities, the Basel Committee, will evolve over time in the next few years. We're moving from a situation where the requirement, by the way, it's still today this way, 2%, okay, because a bank needs to have 8%, but that is a mixture of different components. If you look at common equity, real core Tier 1 is just 2%. Now that will gradually increase to more than 10% if we're talking about systemically relevant institution. And the fact that you announce that to the market that a requirement will go like that means, of course, that the markets always react immediately and require financial institutions to hold more capital. Now, as a bank, if you're required to hold more capital, it means you're more constrained in lending because capital is proportional to especially risky assets like loans. So the only way you can deal with that is in some way well, it's called rationalize, restructure assets, but at the end of the day, it means reducing lending, okay? And in Europe, the European Banking Authority stepped in and required immediately 9%. Now, the factors that I mentioned led to a significant decrease in credit supply. This is bank credit growth in the euro area, and it shows clearly how it went down in the last few years in all the main countries. So a key turning point here in Europe is really the European Banking Union. Why is it a key turning point? Now, first of all, what do we mean? We mean a single supervisory mechanism, the SSM. This has already been approved by the European Parliament. It will become effective next year. It means that the largest 140 banks will be supervised by the ECB. Okay, that's one piece. The other two pieces, which are still missing and would be really effective, is one, a common crisis resolution mechanism, which means if a bank fails, okay, there will also be a common fund in Europe to intervene. Why is that so relevant? In the US, think about Citigroup. And think about what Citigroup, as you know, has been saved through the intervention of the Federal Reserve, okay, and the US government. Think about if the city of New York had to save on its own Citigroup. Okay, or think, for example, other banks, Wachovia in California. The individual states would not have the capacity to deal with this type of large banks' failures, okay? But in a federal system, you have the ability to address this type of crisis, okay? And that would be crucial. However, second point, we still lack the agreement, okay? So when you ask, say, the European Authority, even the ECB president, he would say, well, first of all, if you know there's going to be an asset quality review and a stress test next year for the major banks, if there is a capital shortage, they would need first to go to the capital markets. Then the local state, the national state authorities, and finally the European Common Fund. And of course, a third element would be the common deposit insurance system. Now, if we really managed to get to a full European Banking Union, then you would break the link between the individual sovereign's credit quality and the banking credit quality, okay? And so, in some way, the cost of funding for Italian banks would not be linked to the cost of funding of the Italian government, and therefore the cost of funding for companies would be significantly reduced. And this can be done without actually paying necessarily the cost. Just a commitment would be enough. Like, for example, for the OTM. If you think about the OTM mechanism by the ECB, Mario Draghi said, we are willing to do whatever it takes. It's never been used for Italian government bonds, okay? But indeed, in terms of, saving, but indeed, it has been very effective in reducing the spread. So that's a crucial step. Just a quick focus on our country. We all know what are the weaknesses of our country. We all know them. But I would like to just spend a few words on some of the strengths. We didn't really have major macro imbalances. If you look at the real estate market in Italy, you don't see that type of boom that has been recorded in Spain or in the US. Low private sector debt, that's very important to highlight. Prudent fiscal policy. We are one of the few countries in Europe with a primary surplus. A strong manufacturing industry, and that is still true. Improving external position, and high share of public debt held by Italians. The share of public debt, it's huge, yes, but nowadays more than 70% is in Italian hands, which means it's in one hand owing money to the other, right? Just a few data. This is the external position. Look, we now have not only a trade balance, which is significantly positive, but the current account in 2013 became positive, which is, of course, a very good sign. If you look at the total debt of our country, so you add the blue, which is government debt, to the private debt, which is clearly lower than in other countries, you have a total debt over GDP in Italy, which is similar to many other countries like the US, UK, and so on, Canada. And of course, that's very effective. The second largest European manufacturing economy, and it's still true in terms of gross value added and share of GDP. So to conclude, what is the way forward? Now, the way forward, I think, in Europe should start by saying we had the euro, the common currency, as a result of a very simple principle. We cannot have in an area of many countries where you want to have free international trade and free international movement of capital. We want this. We've been used to that in Europe, okay? And we also want fixed exchange rates, because that's very good for international trade and for many other reasons. Now, if you want these three things, you cannot have flexible exchange rate. And the history has taught that to us. So that's why we arrived at, we basically gave up independent monetary policies. We centralized that, we created a common currency, and we solved the issue of the inconsistent quarter. But the sovereign debt crisis and the deep recession clearly taught us that this is not enough, that monetary union, common currency is not enough. We need a step forward. And this step forward, of course, is a stronger degree of fiscal integration. European banking union is a very crucial step ahead, and we need a stronger balance sheet at the federal level to deal with local crises. Of course, this does not mean that all the rest is fine. It means that, of course, we also need, in countries like ours, significant structural reforms of the labor market, of the tax structure, and so on. And this, of course, is strongly needed. It's a difficult challenge, but I think recent positive signals of economic recovery in some way make it more likely to take place. Of course, one missing point is, in some way, political leadership, which is in some way something very much missing nowadays in Italy and Europe as a whole. Thank you.